go to administrative item number 9, approval of the fiscal year 2024-2025 Statement of Investment Policy, presentation by Ryan Smith, our Finance Director.
Thank you.
Welcome.
Thank you. Good evening, Mayor and Council. This item tonight is going to be our annual adoption of our investment policy and a kind of our annual review of our investment program. And that's going to be done by Elaine Sampson, who represents Chandler Asset and manages our funds. So I'll turn it over to Elaine.
Welcome, Elaine. Good to see you.
Hi, thank you, City Council. My name is Elena Marie Sampson. As Ryan Smith stated, I work for Chandler Asset Management. The first thing I was asked to do was just give a quick update on what the recommendation changes are to the investment policy. There are 5 categories of changes. One is related to a change in the government code with regards to placement services. It's not a product that the city uses, but we just like to keep the investment policy up to code. The second change is with regards the same item, but just making sure that all the financial institutions are allowed under code are also updated. We clarified that minimum credit ratings are at time of purchase. The fourth item is just clarifying, again, this is something that came from CDAC with regards to their definition of what is surplus funds. So we made sure that that was included. And the last thing was to remove from the glossary items that are no longer in the investment policy, as in the CDARS program, which is no longer called that any longer. So those were the updates, really minimal changes to the overall investment policy that we helped to redline. And so then in terms of the economic overview, I'm going to provide a quick update on the economy and then move to your investment policy. So I'll work us through the presentation. Although we have included the entire presentation, I'm going to keep it tight and not go through all of the slides. So happy to answer any questions that do come up. So the key story that we'd want to point to is that it's been a bumpy ride down from inflation from the highs of 2022, coming down towards the Fed's 2% target. That ride has been hampered by resilient housing prices as well as the national labor market remaining stronger than expected. There are cracks starting to emerge with regards to our economy, and this has caused a lot of volatility in the bond markets, which is what you see on that bottom paragraph. So when I look at employment on slide 4, the non-farm payroll jobs have remained resilient, again, on a national level, with 272,000 jobs added in May, and unemployment remaining at 60-year lows at 4%. However, I would note here at home in California, our unemployment rate is on the high end at 5.3%, and we only added 5,200 jobs last month. So very different picture than what we are seeing on a national level, and we've been hampered by some of the strikes that have been happening all up and down the state. So inflation, which is what the Federal Reserve has been most focused on, has continued to trend in the right direction, coming down, but not quite at that 2% level. The Federal Reserve points to high costs impacting those who are least able to afford it, being a real detriment to our economy. So this is part of the reason why they're very much focused on bringing inflation down to a 2% level. And when the Federal Reserve talks about inflation, they're talking about the right-hand side, the personal consumption expenditures, that dotted line. Moving forward to the consumer, so in terms of how the consumer is doing, if I combine March and April on this page, you can see that the consumer continued to be rather resilient in the first quarter. But again, as I said, there are cracks emerging in the system. When we look at May, it came in lower than expected. And this actually points to the fact that 20% of earners, the top 20% of earners in our country actually account for 45% of the spend. So the really, really top part of our socioeconomic range is the ones who are doing the spending. So when we average that out, that can kind of look a little skewed. But if we look on the right-hand side at confidence, it tells a little bit more of an interesting story in that we feel good about the present situation, but we've all felt very anxious for 2 years about where the economy is going. So that's really starting to show in terms of how people are spending. At the top of the presentation, I mentioned housing and that being continuing to be resilient. Existing home sales have continued to fall in terms of numbers of sales. With homeowners having low mortgage rates, if you already own a home, it's really hard to decide to want to move out and take on a mortgage of 7% at this point, which is where we're at. And for first-time homeowners, home prices actually have hit a record high yet again with these 7% interest rates, which is really causing a lot of folks to be priced out of the market. Here in Orange County, I would point out that the average home price is about $1.1 million, so really high prices again for those first-time home buyers. And homes, when they are priced, move from being on the market to a pending sale within 10 days. They also move really, really fast. So all of that is what we've been focused on as we invest your portfolio. So I've moved on to slide 13 with bond yields, wherein each time the market hears any news that the rates might get cut or that inflation might be coming down, we see a drop in yields, but yet again, we see them pop right back up. So in December, they went down as far as 3%, in that 3% range, but have since recovered and continue to oscillate as we have debates over when the Fed may or may not cut. Presently, the market has priced in 1 or 2 cuts, likely in the last quarter of this year is when it's been priced in. So if I move forward to your portfolio, by California government code and your policy, our focus is on maintaining safety and liquidity in our duty to the public's trust, and then earning a market rate of return in line with the city's chosen benchmark. The city is in compliance with your investment policy and California government code, so that's a very important point, and you can see that detailed here on the presentation. So with regards to your portfolio characteristics, the average yield of all of the purchases within the portfolio have continued to increase as we've been reinvesting in this higher rate environment. This is a high quality portfolio at AA. I will note that the federal government is rated AA plus by Fitch and S&P and AA negative by Moody's. So that's the comparison there in terms of being highly rated. Your portfolio has some corporates, which is what brings it down that slight notch. And then the last point, the portfolio's income is now strong enough to overcome the inverse relationship between market yields and market values. And that's a very important point because the portfolio value managed to increase by $300,000 in just that one quarter, despite market yields going up. So that really demonstrates the amount of income that's being generated in your portfolio. So my last comments are just, I'm going to jump down to the purchases that happened last quarter. And this really just reflects some of the transactions. You see that we've been able to lock in yields of somewhere between 4.24 to 4.55%. With securities that are going to mature in 5 years. So as the Federal Reserve begins to cut rates, you'll see that unlike in December when yields came down to 3%, your city will benefit from having these higher yielding securities in your portfolio for 5 years and help you even as interest rate environment starts to move lower. So thank you very much for having me, and thank you for your trust of Chandler as your investment advisor.
All right, thank you. Any questions?
I have a question.
Councilman Harper?
So can you go back to slide 19?
Yes.
So what's the difference between the purchase yield and the market yield?
Yes, so purchase yield is the average of all of the securities within your portfolio. That would include securities that were purchased in 2020 and 2021, which had yields of less than 1% oftentimes, and securities that we've been investing in more recently, which we were just chatting. There was a recent security that was purchased at almost 5%, so that averages out to 3.1%. The market yield is if we were to purchase the entire portfolio as of May 31st, 2024, that would be the yield of the portfolio. So securities that have a lower yield would have unrealized associated losses. Just to give you a sense of what that looks like and what I'm referring to, I am just turning to a page on your holdings. Any security, I'm using agency CBMS as an example on page 33. You can see we have a security there that was purchased in July of 2021 at a book yield of 0.78%. If we were to sell it, we would have a realized loss. So we always look at what is the balance to take a realized loss in order to reinvest at a higher interest rate. So overall, to your question, the purchase yield is at 3.1%. And if we, again, were to purchase all of the securities today or as of May 31st, that's what the market yield represents.
So if the interest rates kind of go down, will the two numbers kind of reverse? The purchase yield will be higher than the market yield?
Over time, yes. Initially, though, because there's still those lower interest rate securities that are in the portfolio, you'll still see it tick up for a while longer.
So it's kind of a lag. Okay, thank you.
Any other questions?
Actually,
Vice Mayor Bowie?
actually, you might have to educate me a little bit on this one. I don't know about how other council members, probably not Councilmember Harper and Vice Mayor Glendes. They are somewhat background.
You're Vice
I'm sorry, Mayor Glendes, because they have a little bit of background with CPA. I don't. In the term of fund of the public fund, I noticed it's a lot of it is in the United States Treasury.
Yes.
Is that the only area that we could put in, or I don't know how does that work exactly?
Sure. So the majority of the portfolio is in U.S. Treasuries. I'm going to flip to that slide. That's slide 20. It's in 43% of the portfolio is in U.S. Treasuries, 15% in federal agencies. And the main reason for that is our primary focus is safety and liquidity, and the U.S. Treasury market is the most considered the most safe and liquid market in the world. And so therefore, if the city were to require those funds very quickly, we want to have a number of securities that are easily marketable and it can easily be sold on the city's behalf.
Okay. The only reason I asked that question is because I'm looking on the private side. I don't know anything about the public side.
Yes.
For example, I'm looking at the overall performance, right? I see it was like 3 point something, right? But currently, for example, if a private individual have money, they could put in a saving account at Goldman Sachs, and it's not locked, and it's like below 5%. So how does this come in play? You know, I mean, I'm looking at it. It's not locked, but yet the interest is
Yes.
higher.
Yes. So similarly, we are able to invest in those kinds of securities. So for example, we recently invested in Home Depot as a corporate security, and we're able to lock in that 5-year security at 4.95%. That was a recent purchase that we took place in the last week. So we are purchasing with new money or any of the interest that is being earned by the portfolio with yields that are very comparable to what you're looking at that a public person could purchase.
Okay. Thank you for that clarification.
Excellent. Any other questions? All right. So I think we need to have is anything else, Ryan, you wanted to add?
No, the recommendation is just to adopt the investment.
Okay.
policy.
Do I hear a motion to adopt the investment policy?
Yes.
I'll move to adopt it.
Okay, we have a motion by Councilman Harper, a second by Councilmember Constantine. Let's vote.
Item number 9 passes 5-0.
Okay, thank you. Thank you.